So far in the month of January, exact numbers, 6,690 contracts delivered, about 33.45 million ounces of silver. And in terms of gold, it was almost 600,000 ounces of gold have been delivered in just the first week of delivery on COMEX. And so for me, what's really different above all else is that, this is a situation where continuously we're seeing the most well-informed traders here in the United States go to great lengths to stand for delivery on precious metals. That's something we never saw before. And the U.S. has become a net importer of gold after being a net exporter of gold for the last 40, 50 years. So I don't know, I would say that to me is the most different characteristic I've ever seen ever in this industry, where COMEX has been more than anything a vehicle for speculation and exports. Now all of a sudden we're seeing deliveries that are so far outside the realm of what is normal that it's impossible to ignore. And
growing concerns about fiat currency stability are driving renewed interest in sound money. According to precious metals expert Andy Schectman, rising gold prices have long signaled currency weakness, while silver remains historically undervalued despite growing demand. Schectman argues that central banks are losing control as cryptocurrencies gain adoption, not as a threat, but as a distraction from failing monetary systems. With finite supplies of gold and silver, supply-demand imbalances are inevitable. As digital assets attract attention, physical metals quietly reflect the true erosion of purchasing power, positioning silver and gold as critical stores of value in an uncertain financial future. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
If you look at gold, it's outperformed the S&P for 25 years, average 9.9% versus 9.6%, just barely. But that's even with dividends reinvested the whole way. No one does that. And you look at the last several years, gold is starting to pull away from it, so is silver. And I would just simply say to you that this is not the time to be riding this late stage in an equity market that's paying nothing in the way of dividends, that is overextended, and is detached from the real economy on the back of an inverted pyramid. In other words, 7 stocks holding up the other 493. I don't know. I think it would be very bullish for gold overall. Look at gold and silver as the two. I mean, platinum has got a lot of potential. It's just hard to come by in the physical world. There's not a lot of it these days, and U.S. Mint hasn't made any in a couple of years, and what is made in tiny volume by the mints and the refineries. But I think silver is the buy of a generation. I mean, the U.S. government calls it a critical mineral. The European Union did that a couple of years ago, called it a critical mineral. And now China, of course, as everyone's talking about, is implementing export controls, considering they refined 70% of the world's silver doré. But what no one is talking about is that in November, a few months earlier, they said we're going to prioritize our silver for domestic consumption. So not only are they tightening their exports, but they are also favoring domestic consumption over foreign export and for the potential of silver. But when the music stops, you want to be in gold. So I look at them in some ways quite equally. Silver is going to give you greater, a greater return. Gold is going to, I think, ultimately shock people how high it goes, but I don't think you'll get the leverage that you get with silver right now. So I guess for me, it's 50-50. I like them both, and I wouldn't be surprised to see both of them go higher this year than just about every analyst on the planet thinks they will go.
Right. Okay, so I'll ask you this question, Andy.
But can I just say one other thing?
Yeah.
I don't tell people to buy this stuff to get rich. You don't buy it to get wealthy. It is wealth. It's wealth that has outlived everything the world has ever thrown at it. And here we are, 6,000 years after together they were mentioned 700 plus times in the Bible, and the biggest, most well-informed money on the planet. Central banks, commercial banks, sovereign wealth funds, whoever the hell is standing delivery for hundreds of billions of dollars on COMEX, whoever the hell is draining the LBMA. These people do not do this for the hell of it. They know where it is going and what it means to have gold and silver at a time like this, when one is being considered critical and the other is being rewoven into the monetary system. So you don't buy it to become wealthy. You own enough of it, you will. You buy it because it is wealth. If you take the price of a house in 2005 as an example versus the price of a house today, your house has doubled. Price of a house in '05 was about $230,000 average in the United States, and today it's about $450, almost $500. So it's doubled, done real well, right? Price of gold in 2005 was $450 roughly, and today it's almost $4,600. So in other words, if you take $450 into 230,000, you get somewhere in the neighborhood of just over 500 ounces. You could have bought a house free and clear with 500 ounces of gold, just over like 520. But you didn't. And it's a good thing because your house doubled, right? And you did well with your mortgage that's now almost paid off 25 years later. Just got a few more years left and you paid off your mortgage. But your house doubled, so cool, right? Well, the price of gold, on the other hand, that's been sitting under your mattress for 25 years earning nothing but dust, has gone up from what? 450 to, it's gone up tenfold. That gold now, the 500 ounces, is worth $2.5 million roughly or whatever. It will buy you 5 houses. So when you talk about assets measured in gold, they're all deflating. When you talk about assets measured in dollars, they're all inflating. This is the whole reason why you don't save your assets. You don't save your wealth in dollars, rather. You save it in assets, like gold, because it is quietly, like the tortoise in the race, quietly outpacing everything. And that's what it does. And you go back through all of time and you'll see something similar to that. Look at a $20 gold coin, which is virtually an ounce of silver, that was minted from 1850 to 1933. And back then in 1900, a $120 gold coin would buy a finely tailored suit, shoes, tie, the whole 9 yards. That's what $20 would buy you in 1900, finely tailored, one $20 gold piece. Well, $20 today doesn't even buy you shoelaces hardly, but that 1 ounce of gold will buy you one hell of a nice suit with the shoes, with a sport coat or overcoat to wear when it's cold. The whole 9 yards. For $5,000, you can buy one hell of a nice suit and everything you need to go along with it. But that's the same thing that we saw in 1900, right? So all of that time, the ounce of gold has held its value and in fact increased its value in purchasing power as the currency has fallen apart. Take a look at a dime in 1964, which had 90% of its weight was pure silver. Well, today that dime is worth, in melt value, north of $5 an ounce, or north of $5 rather, for that dime. And just in melt value, what's the dime worth? Nothing. I mean, it's worth a dime, but what is a dime really worth? Point of it is that when you compare currency and money, you see that the currency, everything is getting more expensive. When you measure it against money, which is gold and silver, everything's getting cheaper. That's the reason you hold on to gold and silver, not to become wealthy, but because it is wealth that will protect you in the face of a continually debased currency that goes on and on and on. And we're in the late stage game where it will, I believe, increase in devaluation. So this is the whole idea. Look at your dollar as a melting ice cube. Look at your gold and silver as your wealth, and that's how I hold it myself. I don't buy it to become wealthy ever. I buy it because I would much rather hold my money in gold and silver, which appreciate.
Rising interest in cryptocurrencies and precious metals highlights growing instability in global monetary systems. As gold prices rise, they signal weakening fiat currencies and declining central bank control over sound money. Governments encouraged cryptocurrency adoption to divert attention from gold and silver, often marketed as digital gold. However, mounting physical shortages, especially in silver, are exposing cracks in paper contract markets like COMEX and the London bullion market. Despite volatile spot prices, silver remains fundamentally undervalued due to finite supply and rising demand. With debt, interest costs, and currency debasement accelerating, gold and silver continue to reflect the true state of purchasing power erosion. Let's get back to the interview.
When you have the whole world rushing to accumulate this stuff, the physical metal that has been levered on the exchanges, my simple advice is, if you're a trader, trade it. But if you're trying to protect your purchasing power, the risk isn't that silver goes from 80 to 70 or that gold goes from 4,600 to 4,500. To me, the risk is waking up in a market where you can't get what you want at any reasonable premium or any reasonable price, and the price you thought you'd be able to pay is gone. So I guess the real answer is short-term caution, absolutely. Long-term conviction, 100%, and they ought to be able to both be true at the same time. In my mind, they are. But when you look at this great revolution of AI and a S&P that was up under 20% last year, well, silver was up almost 8 times that amount, and gold was up 4 times that amount. Quadrupled it in the face of the biggest tech boom ever since the internet. In terms of how would it affect the stock market, and I don't think that this is something you just grow into. I mean, because where's the growth, by the way? When you look at our country, let's just be flat out honest about it. We have a $38 trillion debt. We have almost $200 trillion in unfunded liabilities in Medicare and Medicaid and Social Security and government military pensions off balance. A trillion seconds ago was 31,688 years ago. Ray Dalio just came out and said that 60% of the United States has a reading literacy rate below that of the sixth grade. We're uneducated. Our manufacturing, what manufacturing? We don't make anything. So we're broke, we're uneducated, we don't make anything. AI's here, which is going to kneecap 40-50% of all the entry-level jobs within the next few years and take away a lot of the white-collar jobs, such as being an accountant, analyzing a balance sheet for a real estate investment trust, like my son was doing at Price Waterhouse. He works for me now, but what do they need a kid getting paid $80,000 a year to analyze a balance sheet when AI can do it in 1/10 of a second for free? But this goes on through all sorts of industries. So you look at how do we grow our way out of this problem? We have fiscal irresponsibility. We're broke. We're uneducated. AI is coming. We don't make anything. Do you see that there is a problem here? And that's kind of been my thesis about how you bring back manufacturing for a while. But the bottom line is simply this, that the market is wickedly overvalued. There is a disconnection between Main Street and Wall Street. And I don't think that changes anytime soon. And you ask what would happen to, to the precious metals in the face of a market sell-off? Well, I mean, ask yourself this, by the way, before you even think of that. Why is Warren Buffett sitting on $400 billion in cash? Why did Bezos sell $7 billion in Amazon? Why did Zuckerberg and Jamie Dimon and why are they selling? And why are the insiders for most of the year last year selling between $1 and $3 billion a week in equity? Point of it is that the insiders are already tiptoeing out as the public is all in. Largest percentage allocation, mom, pa, retail public to the equity market ever. Largest percentage of option investment ever by the retail public, and largest amount of margin debt ever by the public, about $1.5 trillion. So you got the public all in on margin, speculating through options and on margin. And so as the insiders are leaving, and at the same time you're seeing the biggest money in the world stand for delivery in metals, and no one knows who it is. What could possibly go wrong in all of this? What I will say to you is that the public will be left holding the bag, and the big money is already quietly tiptoeing. Look, the central banks have been doing this for years, and now you have the big traders here in the U.S. I think it's inevitable that we see a pullback in the equity market. And what does it do? I don't know what it does to the precious metals market. It is inversely correlated, they say. You would expect it to go much higher, but all I can say to you is that this is a time, I believe, to stand away from the equity market that has risen to tremendous heights, has done so on the back of 7 stocks, has done so as the economy underneath it does not support its growth, in my opinion. So return on money is nice. Return of it's a whole hell of a lot better.
Rising gold and silver prices reflect growing demand for physical metals as investors lose confidence in fiat currency and paper markets. Despite bullion banks' ability to create unlimited paper contracts, gold and silver prices rise because there is no substitute for their unique physical properties. Used across energy, technology, manufacturing, and infrastructure, precious metals maintain real-world demand unmatched by fiat money or cryptocurrencies. As debt, currency debasement, and systemic risk accelerate, gold and silver stand above governments and central banks as true sound money. With the gold-silver ratio compressing and physical demand expanding, precious metals represent lasting monetary power in a shifting global system. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.